Welcome to Lender Force-Placed Insurance Litigation and the Filed Rate Doctrine in Florida. My name is Dennis Wall, and I appreciate your being here today. I gave this presentation to the Florida Bar in September 2018. I've updated it throughout October 2018. This is not a big production. It's just the facts and just the information, and it's free. This is one person's exploration into Lender Force-Placed Insurance Litigation and the Filed Rate Doctrine in Florida. As for me, I am interested in finding out about things like lender force-placed insurance practices and why they work and how they work. I have tried to be objective in the book, and I've tried to be objective in this presentation. Sometimes the facts may have affected me, but throughout I have tried to be objective, and hopefully I've been able to achieve that. Slide 3 gives some other examples of me trying to find out how and why LFPI works. And I would note at the beginning that PowerPoint conversion to video only gives you so many seconds per slide. For example, converting a PowerPoint to video for YouTube. So I have tried to stay, so that you know up front, within 30 to 35 seconds per slide. So if there's some dead air time along the way, that's the reason why, or at least one of the reasons why. And along the way, we're going to talk also about that defense called the filed rate doctrine. Forthcoming in the fall, it should be on its way from LexisNexis, I have an article about the filed rate doctrine called Filed Insurance Rates. Do not belong to the federal government, they belong to the states. It'll be published in New Appleman Current Critical Issues in Insurance. And in that article, as in this presentation, we're going to take a look at what the FRD is and how it works. We're going to be covering the basics of lender force-placed insurance. If you're already familiar with it, I apologize, but not everybody is aware of what LFPI means or what it does. So let me lay the predicate, as they say. LFPI is found in virtually every loan agreement. It is a required agreement in Fannie Mae's and Freddie Mac's uniform mortgage instruments that the lender has the option to impose insurance to protect the collateral at the borrower's expense. More basics. Not everyone understands the basics of LFPI insurance or collateral and protection of collateral and collateral protection insurance. Not every judge understands the basics of those things. Instead of turning them off, consider making it easier for judges to rule in your client's favor, including starting with the concept of collateral, protecting the collateral by two kinds of insurance, homeowners insurance and collateral protection insurance, and who pays the expense. And so, we all agree to LFPI if we do not make the loan payments or we do not keep insurance in place. That's standard procedure in Fannie Mae and Freddie Mac mortgage forms. Again, the gist or gravamen of the LFPI case law is what expense can be charged as a result of LFPI being placed. Slide 8 shows what the LFPI cases are all about. These are the allegations of unauthorized expenses that the mortgage instruments do not permit, allegedly, such as kickbacks, tracking services to track whether insurance is in place to protect the collateral, clearly a cost of doing business for the lender, and reinsurance paid to lenders' affiliates and subsidiaries, as well as agents' fees for non-existent agent services, and premiums which are really penalties, not charges for coverage. We're looking at where the information was made available to the public. And the information is made available by courts and their unsealed files in exhibits to pleadings, officially reported and what I call officially unreported judicial decisions, depositions, interrogatory answers, affidavits and declarations, and allegations. And it is very difficult to find this information on PACER when the clerks simply label some exhibits as Exhibit 1 and Exhibit 2, for example, but we'll find it. Our focus on lender force-placed insurance is a focus on forensic investigation of the actual court files. We're looking at what the parties testified, what the documents displayed, not so much of what the attorneys argued. We look at what the attorneys argued for some information or facts or to give us some perspective on the claims and defenses in the case, but we're basically looking at what the parties testified and what the documents displayed. That's our forensic investigation. Secrecy stipulations make the project even more difficult in finding out about lender force-placed insurance practices. Enough of the information has been made public to allow my book and articles about it, to allow this presentation, despite the presumption of public access to court files. However, these files, like so many court files, not just LFPI cases, are kept a secret from the public. As a result, we have the complaints. But in LFPI lawsuits, the complaints have not been successful when they challenge the lender's contractual rights to force-placed insurance, which we have seen is a standard right in the standard mortgage instrument. The LFPI complaints that are successful in withstanding motions to dismiss allege claims on account of damages for unauthorized expenses. Two crucial features of LFPI to keep in mind. First, LFPI ordinarily protects the lenders and not the borrowers. It is collateral protection insurance for the benefit of the lender and its loan. And the second thing to keep in mind is that LFPI is always paid by borrowers, although it is always placed by lenders. Not sometimes, not generally, not often, but always. Like many other things, LFPI practices changed as a part of the Great Recession. They changed from producing protection to producing revenue. As it can be seen from the quote on slide 14, one of the lender's attorneys argued in an LFPI case in California, it could have been anywhere, that it is in a lender's best economic interest to receive more revenue than repayment of the principal balance of the loan. Quote, a lender wants a performing loan or asset, not immediate repayment. Whether you represent the plaintiffs or the defendant, the homeowners or the lenders and servicers and their agents, here are the kinds of things to look for, the kinds of things that will be the subject of discovery in LFPI cases. This presentation will show you the figures that we have. These are the kinds of things that you will have to discover and will be the subject to discover in your LFPI case. I am not trying a case here. Starting with slide 16, we take a look at the elements of unauthorized charges, the kinds of things to look for in LFPI cases. One of those things, foremost among those things, are commissions. And as we know from testimony given in 2011, that over the course of 4 years, a lender servicer aggregated $400,000 per year in LFPI premiums, representing a total of $1.6 billion for those years, on which it charged a commission. The commission that was charged by one lender was 11%. So the amount paid by the carrier, the lender force-placed carrier providing the policy, was payment in commissions to the lender of 11% of $1.6 billion over those 4 years, or $176 million in that particular case to that one lender. Looking next at the amount of reinsurance premiums at issue in LFPI practices, we know from a motion for attorney's fees, an application for attorney's fees in an LFPI case, that there was a representation to the court for attorney's fees, that the lender in that case, different from the lender involved in the previous slides, was more than $600 million over the course of 6 years, which would represent $100 million per year for reinsurance premiums. Backdating, excessive policy limits, and other unnecessary insurance is also a part. They are also a part of the unauthorized expenses for LFPI insurance. However, we don't have the pleadings or the testimony or the documentary evidence to break this out from which to gauge the amounts that are involved in any particular case of backdating, excessive policy limits, and other unnecessary insurance, although virtually every LFPI case will involve these things. we do have at least a trio of fact pattern examples, which I present in these slides. Number one is an example of unnecessary insurance. This is a premium of $1,575 that was charged on a HELOC or home equity line of credit that had a zero balance. The homeowner was charged a premium, in other words, or an expense of $1,575 to protect a line of credit on which she had a zero balance. In slide 21, we have a second example of unauthorized expenses. We have an example of an alleged unnecessarily high policy limit. The policy limit in that case, force-placed policy, was over $250,000. The annual premium was over $5,000. The original loan amount was almost $100,000 less than the coverage limit. We have a third fact pattern example on slide 22 involving two binders of force-placed flood insurance. Both were 90-day binders. Both were for coverage limits of $250,000. The original amount of the loan was $115,115. The unpaid balance was approximately $113,000. But as anyone knows, when you have coverage limits so far in excess of the amount you want to cover, you're paying through the nose for it. There are many alleged causes of action in LFPI cases. Some are common law causes of action, some are statutory claims under federal and state statutes, and the most frequently alleged claim or cause of action in LFPI cases is breach of contract, which makes sense because most cases involve lenders, others involve various other defendants, but the contract, the mortgage, is between the borrower or homeowner and the lender. As I said, the breach of contract cause of action is most successful in withstanding motions to dismiss in LFPI cases when it's alleged against lenders. But I put an asterisk on this slide 24 to remind you, that none of these LFPI cases has been found which ever went to trial strictly on LFPI claims. I haven't found any. There have been anecdotal reports of cases involving LFPI claims and other claims which went to trial, but I haven't found any of those either. Perhaps the most interesting type of federal statutory claim is under the Truth in Lending Act. The Truth in Lending Act, in basic and simple terms, requires disclosure of credit events. Well, it requires disclosure of the credit's finance charges, the amount financed, annual percentage rates, and insurance premiums, among other things, before the credit is extended. The Dodd-Frank Act made changes to the Truth in Lending Act, and as we all know, the Dodd-Frank Act is under attack. So even if you took the Dodd-Frank Act away completely, let's take a look at what happened under the Truth in Lending Act. In terms of the court's decisions regarding LFPI cases, the courts decided that the TILA Act applies to LFPI cases. Following the vast majority of cases that hold that TILA applies to LFPI cases, my prediction is that TILA claims are the wave of the future in LFPI cases. And I have several reasons for my prediction. On slide 27, I begin with them. The first one is jurisdiction under the statute, placed both in federal and state courts. Second, where the disclosure is required by law, that's really the only question. When you have a case in which there was no disclosure. A third reason for my prediction that TILA is the coming wave in LFPI cases is that under the Act, individuals with comparatively small damages claims can recover actual damages and, in addition, would amount to statutory penalties in a range of not less than $400 or greater than $4,000. If it's a class action, the amounts are different, but as we will see from a later part of the presentation, class action claims are not really viable. So, despite the apparent demise of class actions and the lack of usefulness any longer, at least under federal law, in LFPI cases, whether it's TILA or any other cause of action or claim, TILA does allow the recovery of an individual plaintiff's costs and attorney's fees in each individual TILA action. I want to note along the way that, again, even before Dodd-Frank, the TILA statute of limitations was 1 year from the date of the occurrence of the violation. Not 1 year, by the way, from the date of the Great Recession, not 1 year from the day of the other date, but 1 year from the date of the occurrence of the violation, which is, again, under TILA, the non-disclosure that a TILA would require. Now, to the extent that the Dodd-Frank, or at least this portion of Dodd-Frank, is still viable, remains, the TILA statute of limitations after Dodd-Frank was extended to 3 years for certain kinds of violations. They're listed in the statute, and the citation of the statute is on slide 31. And again, the beginning is the date of the occurrence of the violation, the same as before. There are, of course, also causes of action available under state statutes. One example is the Florida Deceptive and Unfair Trade Practices Act, which I call FDUTPA or FDUTPA. If you call it something different, that's okay, you can. There are 3 elements: a deceptive act or unfair practice, causation, and actual damages. And it's a perfect fit for LFPI cases because FDUTPA claims require allegations of conduct different from, in addition to, conduct authorized by a contract. To put it in basic and simple terms, FDUTPA reaches LFPI practices. Defendants in those cases, with no limitation shown by the cases, include mortgage servicers and lenders, and examples of allegations withstanding motions to dismiss under FDUTPA in LFPI cases include, and in cases under other states' Deceptive and Unfair Trade Practices Act claims, include commission arrangements, failing to seek competitive bids in the open market, backdating policies, and taking kickbacks. And importantly, Deceptive and Unfair Trade Practices Acts, including Florida's, allow the recovery of attorney's fees in addition to actual damages. Under the Bull Motors case in Florida, cited on slide 34, proportionality of fees to recovery is not required. There can be a wide discrepancy between the award of actual damages and the assessment of attorney's fees or award of attorney's fees, as shown on that slide. And importantly as well, lodestar enhancement of attorney's fees is available. And once again, we bump up against secrecy stipulations in LFPI cases. Typical secrecy stipulations in litigation, including LFPI litigation, provide that the parties shall mark evidence in discovery as confidential, usually in all caps, and discovery has no shelf life in those cases, meaning it has no life beyond the actual case that the discovery was taken in. It shall not be shared with any other lawyer in any other case involving the same defendants. Now, in terms of the net effect on knowing what is in the public court file, it's a secret. Even though the default presumption is openness of court records, secrecy stipulations keep, understandably from the lender's perspective, lender force-placed insurance practices a secret away from the public. If you're interested in learning more about LFPI litigation and practices, there is another YouTube available. The link is on slide 37. From this point forward in this presentation, we're going to take a look at the file rate doctrine, both across the country in federal courts and particularly in Florida. There are some interesting opportunities available in Florida in particular. We are going to be talking about what the filed rate doctrine is, what it does, and is there a filed insurance rate doctrine in Florida? And is there a filed rate doctrine in Florida LFPI cases? So we're going to be taking a look at all these elements of what is a filed rate doctrine and talking about them in the context of LFPI cases in particular. But what's talked about here is representative insurance cases in general. We should begin with the most important observation about the FRD is that it is judge-made. It is made by judges. It can be changed by judges. It began in federal courts. First, it began in cases involving federal agencies regulating utilities. The utilities filed rates for regulatory approval. Federal judges held in those cases that approved rates charged by the utilities were the only lawful rates that they would recognize. What it is extended. Does the filed rate doctrine, FRD, extend to insurance? It involves also the corollary part of the federal court's doctrine that you cannot collaterally challenge rates that have been approved by authorized agencies if you award damages to the plaintiff in a given case. You're giving that plaintiff a break on the rates that were charged to everybody else. There are two strands of the filed rate doctrine. That's what the courts call them, strands. One is non-justiciability and one is non-discrimination. Either one of these is enough if it's present in a given case. Non-justiciability is a favorite of judges. Non-justiciability means that judges are incapable of determining calculating the rates involved. Non-discrimination means, as I indicated before, you're not going to give a break to somebody and not give it to everyone else. The filed rate doctrine, first and foremost, is a defense. It only applies as a defense when the charge that's involved in the case is regulated as part of a filed rate by an agency authorized to regulate it. I'll say that again. The elements of the defense are that the charge involved in the case is regulated, and it is regulated as part of a filed rate by an agency that's authorized to regulate it. The FRD does not apply when the charge at issue is not regulated. More about what the FRD does is shown by the Florida Municipal Power case decided by the 11th Circuit. That's a very important case. As they point out, I'll take the second point first, that you've got to look hard at whether the charge at issue is regulated to see whether the doctrine applies. And importantly as well, characterizing the plaintiff's claim is critical to whether the filed rate doctrine will apply. That involves the question, of course, of whether there is a filed insurance rate doctrine in Florida. LFPI cases, after all, involve insurance. So one response to the filed rate doctrine in LFPI cases is a response for all insurance cases, and that is if insurance rates are regulated by a state, such as Florida, then that state's law regulates the filed rate doctrine. Title insurance cases give an example where a state's law regulated title insurance, then the FRD could apply, but if it did not regulate title insurance, it did not apply. And the question about whether the filed rate doctrine applies in LFPI cases has so far come up in the court in which most of the LFPI cases have been filed, and that's the Southern District of Florida. To be clear about where the filed rate doctrine has come up and how often, it has come up only in the cases that have been filed in the Southern District of Florida. This involves an interesting procedural question because most of those cases are resolved on motions to dismiss, involving questions of plausibility. Continuing from the previous thought, there is a different standard involving a summary judgment. And that standard for summary judgment is, of course, whether there is no genuine issue of material fact, and whether the party moving for summary judgment is entitled as a matter of law to judgment in its favor. It's my understanding that motions to dismiss supported by evidence are converted to motions for summary judgment, but apparently not in federal courts and not in LFPI cases. Southern District cases since 2015 have applied a decision in that year. Rothstein versus Balboa Insurance Company decided in New York by the Second Circuit. They have even applied it to motions to dismiss. In the combined Fowler-Patel appeal, the 11th Circuit, a panel of the 11th Circuit, a 2-to-1 decision, applied the federal filed rate doctrine to those cases, and I will give the citations later in this presentation. We have only federal court cases applying the filed rate doctrine. So assume for the moment that the filed insurance rate doctrine in Florida is a federal doctrine. That would mean the real issue is whether Florida regulates lender-force-placed insurance premiums, including kickbacks and other unauthorized charges. It would also mean, of course, that the Florida Insurance Commissioner and what the Commissioner has to say would still be instructive and maybe even determinative of that issue. Returning to the amicus brief I filed in Fowler on behalf of United Policyholders, which was on behalf of the homeowners in that case, its purpose was to show the determinations that have been made by the Florida Office of Insurance Regulation, also known as the Florida Insurance Commissioner, of course, that so-called commissions or alternatively kickbacks and other unauthorized charges are never approved as part of filed LFPI rates in Florida. Now, the citations that I gave to the 11th Circuit are also the same ones I give to you on slide 50. In these consent orders, the Florida Office of Insurance Regulation agreed with the major lender force-placed insurance carrier providers in Florida that none of the unauthorized charges could be included in filed rates, that future LFPI rate filings would not include these charges, and that present rate filings were disapproved because they may have included these charges. The importance of what the State Insurance Commissioner has to say is shown by the Cannon decision decided in California. In that case, ASIC itself, ASIC is American Security Insurance Company, perhaps the major provider of lender force-placed insurance policies in the nation, including in Florida, that their rates were approved by the California Insurance Commissioner. The federal judge pointed out that the commissioner said in the course of approving those rates that he did not pass on unauthorized charges. Therefore, the filed rate doctrine did not apply to kickbacks. Please recall with me the difficulty in finding unsealed testimony and other evidence in these court files. I want to ask your help in locating unsealed testimony and other evidence in recent LFPI case files in Florida and anywhere else in the U.S. I'm writing another article about force-placed insurance. It's not easy, as it once was, to find discovery in the court files on PACER. Do you know of force-placed insurance cases with depositions and other discovery accessible on PACER? And do you know who I can ask that might know? And now the citation to the 11th Circuit panel decision. It is not yet published in Fed Third. It's found at 2018 U.S. App Lexus 27221 and 2018 Westlaw 4559091. As I said, it's a 2-to-1 decision. The majority is written to, the majority opinion, that is written by a 6th Circuit visiting judge who came to Florida to impose the filed rate doctrine. Although the visiting judge from the 6th Circuit could not believe that the dissent was actually pointing out that the filed rate doctrine as applied by the court was really a federal filed rate doctrine, the dissenting judge from Florida did exactly put this in issue and right at the beginning of the dissent talked about the major features of it, including the fact that the states involved, Pennsylvania, because there was a plaintiff from Pennsylvania, and Florida did not apply the filed rate doctrine. As I invite you to see on slide 55, the Fowler decision provides an opportunity here. As the dissent pointed out, even if Florida would apply the filed rate doctrine, it would not apply it to kickbacks. Well, the opportunity here is to no longer file cases in federal court, which seems to be a dead letter after all the Southern District of Florida decisions and the Fowler panel decision, but to file them in Florida state courts, where Florida judges decide Florida law. And to pursue this opportunity in Florida state courts on questions of Florida state law, how will it be done and who will do it and what will happen? In the future, Florida LFPI litigation is up to you. It will be you that decides how and who and what will be done in future Florida LFPI litigation. Thank you for attending. If you have any questions, I would be glad to field any questions you might have. Please post your questions on either of my websites. One is DennisJWall.com, and the other is LenderForcePlaceInsurance.com. Pretty easy to remember. And I would be glad to address your questions and get back to you there. And again, thank you for attending, and I appreciate it. Before closing down this presentation, I wanted to provide some additional information about my background and they provide you as well with one of the websites at which you can leave your questions, and I will be glad to address them. And again, thank you for attending. This is the last slide that I presented in September 2018, and it is the last slide in this presentation now. Thank you.